The show starts in 10, 9, 8, 7, 6, 5, 4, 3, 2, 1.
Okay.
I was really itching that applause.
Yeah, how much time do we have? 45 minutes. Okay. Good morning. We're still good morning, right? Good morning. My name is Shawki Daou. I'm in talent development. Today's subject is about bookkeeping, bookkeeping concepts for entrepreneurs. This course, actually, it's a full day workshop. We're gonna squeeze it and pick the important points from it. But this is for you as entrepreneurs, business owners, to learn how to read the health of your business. Okay, so it is about numbers. Bookkeeping is numbers. Finance is numbers. But today's 1 hour presentation is to highlight the concepts that you need to learn as entrepreneurs and businesses. Okay, agreed? Now, why numbers are important for businesses? Because many people, I've seen this a lot, especially like a young entrepreneur, they think they have a great idea, they have a great business ideas, and they think they can achieve a lot, and they think they can hire someone to do the numbers for them, and they should not worry about numbers. And of course, this is not true. But why numbers are important? Because numbers we can measure, right? We can, if we say I have a good health, how can you measure that? If I tell you my blood pressure is like 12 or 16, you would know, right? So numbers are important for business because numbers tell us about the health of our business, right? And how do we maintain that? And how to make sure by the proper and right bookkeeping. Okay, so we're not gonna learn bookkeeping here, but we are going to understand the main concept behind bookkeeping that we need to learn about as entrepreneur. Okay, and I'm sure you've heard of most of them. So we're gonna have an open discussion. It's not only me who's gonna talk. Okay, we are going to talk all together. Like I said, the idea, you don't have to remember anything. You don't have to memorize anything. You don't have to write anything. If you want a copy of this presentation, I can share it with you. I have like 100-page material. I can share them with you. You can find everything in those material. But now let's think together and let's have an open discussion so we can grasp the knowledge very well, and it becomes kind of nature to us. Balance sheet. I'm sure every one of us, all of you, have heard of this name, balance sheet. What is balance sheet? We can have balance sheet as individuals as well.
So
You wanna?
Well, just go by off the slide. It's basically the snapshot of how you're doing financially, in that moment in time.
It's a snapshot at a certain point of time, and this is very important. Thank you for mentioning that. With all financial reports, we either have a time or a period. Financial statement, any financial statement has no meaning if we don't know what time it is or what period it covers. Okay, we're gonna talk. If I tell you I have a business that makes $100,000, is that good or bad?
Depends on the business.
Yeah. Depends what
It
you owe.
depends on the business.
My business makes $100,000 of profit. Is that good or bad?
That's good.
If it is a profit,
Is it good or bad?
Well, it depends of the business and the industry.
That's good all the way.
Any idea? Yeah, profit. Imagine if this $100,000 over 50 years. That makes it $2,000 a year. So it's bad. So this is why financial statements always, financial reports always have a time, okay, or a period. So if we're talking about like profit and loss, there's a period. If we're talking about financial statement, it's a snapshot at a certain period of time. Okay, yeah. What does it show?
Your financial health of your
I'll tell you a story about financial statements, about the balance sheet that I assume you would like. But let's try to describe it first. What does it state? What do I find on the balance sheet? Your own balance sheet or your business balance sheet.
the financial health of your business.
It tells it exactly. It tells, yeah. And what element on it? Everything you owe, everything you own, right? That's the balance sheet. So I have like $100,000 in the bank. I have $200,000. I'm a business, okay? I have $200,000 in buildings, okay? I have this. I owe this much. So this is the balance sheet. So the balance sheet is a snapshot about the financial values of what you have, whether you owe them or you own them, okay? Reading the balance sheet tells you everything you know about the business, from profitability and from how solid the business is, okay? We all heard of Warren Buffett. Do you know who Warren Buffett is?
Yes.
Anyone doesn't know who Warren Buffett is? You don't know. Okay. Warren Buffett is a billionaire. That's okay.
Oh, wait, did nobody put their hands up?
Someone.
Oh, I know who. I read one of his books. I know.
You read his book?
Yep.
Yeah. His book is interesting. Did you learn from his book? If you
Some-
want to be entrepreneur, it would be good to read the biography. This is a side advice. Good to read the biography of like successful people. You learn a lot from them.
I think we got Warren Buffett's book right there, The Snowball Effect.
The snowball effect, correct? That's the one. Yeah, Warren Buffett. Then you know, if you read his books, The Snowball Effect, you would know you know the story that I'm gonna tell. Warren Buffett, by the way, he's maybe the third or fourth billionaire in the country, right, in the world. He owns something like 200, 300 billion, and he is not a brilliant man. He's not like Steve Jobs or Elon Musk or Bill Gates or those guys or whomever. That he did not invent anything. He was the most boring kid in his age. But he has something more important. He has discipline and he has good understanding of numbers. So what did he? He bought his first stock when he was 11 years old. He bought a stock. How did Warren Buffett make his fortune? From the stock market. And he doesn't like buy and sell stocks. No. He buys stocks of successful businesses and he keeps them. And the stock he bought, if you invested with Warren Buffett $1,000 in the 60s, you know how much money do you have today? You would have today $100 million. That much. Okay? So, what was he good at? He was good at reading the balance sheet of the businesses. From reading the balance sheet and comparing the value of the business with the value of the stock, he could identify what stock is being sold in the market under value and go buy that stock. This method of dealing with stocks, created by somebody called Benjamin Graham, who was his teacher, but Warren Buffett was among the best to apply it. And he has discipline. Okay? So this is why he became the third or fourth or fifth. At a certain period of time, he was the top billionaire. So this is how important balance sheet is. Okay, if you read the balance sheet, try to read it. I know when you see the balance sheet, you look at like some boring form full of numbers who don't make sense, but try to read it, especially if you want to be in business. Try to read it, try to make sense of it. You will start learning like few things. Like there is a line called cash, so you would know how much is this business on in cash. There is an item called receivables. Receivables are money yet to be received by the business, but the business like sold something, and the market owes the business some money. So you know how money the business will receive in a certain period of time. You would see payable. Payables tells you about how much money the business owes for others. You see terms like fixed assets. Fixed assets are the assets owns, but like the buildings, the cars, the equipment, the whatever. Okay, and those assets have value, right? So you would when you learn about all the items now, the more sophisticated the business, the more sophisticated the balance sheet. But take the simple things first to get yourself used to the concept of reading a balance sheet. Okay, balance sheet is the most one of the most important financial documents to read, to maintain, and that's how business people understand the health of their business. Now, of course, there are plenty of reports, but all of those reports are produced out of three main report or three main forms in finance. And those balance sheet, P&L, what we call P&L or profit and loss, revenue and income sheet, and the budget. These are the three main elements. All of those elements, we produce them from maintaining good numbers, good bookkeeping practice. Okay, so these concepts you will need to learn. So the balance sheet is a financial statement that shows assets, liabilities, owners' equities at specific point of time. Always remember that. Balance sheet has a cut-off time. Okay, so the balance sheet of yesterday, well, businesses don't produce balance sheet every day. They do it either every month but they can do it every day, right? So, but usually the practice is every month, and they extract some values from the balance sheet that tells about the health of the business. Who of the audience owns business? Do you guys own business? You own your own business. Okay, and you have an accountant that takes care of your numbers, or you use QuickBooks, you do it yourself using QuickBooks. How do you do it?
I have an accountant.
Okay, and what does the accountant give you? Does the accountant give you a balance sheet?
No.
Okay, you just learn how much you made, how much money you made, and you don't bother to read the balance sheet yourself.
Oh no, it's my actually I would say my tax preparer / accountant. He's
Okay.
not quite doing my accounting.
Okay,
so
it would be nice every now and then to have a copy of the balance sheet and to look at it, to see what your business is worth. Now, it depends on the type of business you have.
Right.
Like business, like my business is only services, so I may not need to look at the balance sheet because I don't have so much
Right, I
items. I don't have like
understand.
assets. I only have like few numbers to worry about. But if you are a restaurant, if you are if you are a business a manufacturer or something like that, yeah, balance sheet would be good to look at your balance sheet every now and then. What kind of business do you run?
I have procurement, but I haven't made any sales or had any contracts or anything like that.
So you're still starting?
Yes.
Okay, that's good. So you invested some money, right? Okay, let's assume I invested like $20,000 in a business. It happened to me in the past. When I spent the money before started earning money, okay, I was worried. What did I do with all this money? I borrowed $20,000. You know, I wanna know. So looking at the balance sheet makes me understand. Oh, I bought those equipments, I bought those computers, I paid this, I paid this, I paid that. So I saw everything on the balance sheet. So it would be good as an entrepreneur to understand the balance sheet, because that would give you the balance and straighten your thinking. Agree? Any comment?
So basically, the balance sheet as a business shows your expenses. And
Balance sheet does not have expenses at all, does not have any expenses and income. Now, the second form we will be looking at is the income statement, or the P&L statement, some people call it. Okay, you may say like different names for. So the balance sheet is your assets and liabilities and equities. Equities are the owner's money in a business. If I put a capital, I spent capital. I put like $50,000 as a capital, that's equity, right? If I own something, that's equity. So equity, liability, and assets, those are the element of the balance sheet. Assets, anything that has value for me. Liabilities, anything that has value that I have to pay. Okay? Everything belong either under assets or liabilities, right? And there is equities. Equities are the pure values that I own as a business. Okay? So if I have a building, if the business owns a building, this is what? Assets or liabilities? This is
when it has
no, this is assets. If I have a mortgage,
that's a liability.
that's a liability. Exactly. If I owe somebody something, it's a liability. That's why the word liability is used in a wide meaning about everything. Anything that I am committed to fulfill. That's a liability, right? So assets, liability, and equity are the element of the financial statement or the balance sheet. Financial statement is a problem. Now, the second form we have, the income statement. The income statement is a financial statement that is used to summarize the income and the expenses. Now, here I have a question. The income statement that shows income and expenses. They call it either P&L statement, profit and loss statement, or income statement. You may find like different names for it. So what is the other element that related for me that is important to understand the income statement? I just gave an example about that, the business that's making $100,000. The period of time. So balance sheet have a cut-off time at a certain time. The income statement has a period. I cannot say like at this time. It has to be over a period of time. Like in 1 year time, I made $1 million sales, and I made $1 million in revenue, and $600,000 in expenses. So I made profit $400,000. Okay. So income statement has a period of time. And the period of time could be like a day, a week, a month, a year. Okay. Usually on monthly basis, businesses review that, and more sophisticated, and they monitor this very closely, because that will determine how much money they are making, if they are working in profit, or if they are going to lose money. So income statement has revenue, the money that I produce as a business, and it has expenses. Okay. Now, it is important to understand expenses. Before moving the expenses, let's talk about revenue. Revenue is easy. All the fee paid to a lender for a loan or transaction for which monies are received. This statement is wrong. The first one is wrong. Okay. I don't know why it is there. That is expense. It can be the income from products and services sold for the use of investment. Okay, so anything. This is talking about financial revenue. Can also be a transaction and the resulting income from which monies are received. Okay, forget about the verbiage of this. Revenue is the money I produce. That is revenue. If I'm an employee, my salary is my revenue. If I'm a business, my sale is my revenue. Whether I sell product or services, that is my revenue, the gross amount. If I sell $10,000 a day, my revenue is $10,000 before deducting anything from it. Okay? Now, my expense are the money that I paid. And studying the expense is very important, and more important to understand where is my expense is going. Okay, there is a misconception for many business starters without experience. If you want to make money, if you have a money and you want to make money, and you look at your numbers and your accountant and everybody tell you, you know something, we're not making enough money. We are barely breaking even, right? So what would you do to enhance the situation as an entrepreneur? What would you do? In one statement.
You work more to make more money.
You work more. That's how we'll see.
Find a way to cut expenses.
Cut expenses.
I have nothing right now.
Increase profit, let's say.
Improve revenues.
Improve revenues. So we have three different ideas. Any more ideas? Okay, let's start with the first statement. Work more of, okay, if we are working like a month and we're not making money, if we work more, we're not making more money, right? We're gonna because the way we are working is not generating money. So this might not be the case every time. It could be the case if like I work 2 hours, I make like $100. If I make like 4 hours, I may make $200. It might work there. By the way, here we don't have like right and wrong answers, but depends on the situation. Okay. Improve revenue. How can I improve revenue? I can make more marketing, open more hours sometimes if I'm making revenue. But does improving revenue really guarantees that I will make more profit? It would help. Let's look at the third option. Third option is reduce cost. Reducing cost is the most solid solution when you can apply it to improve your profit. So all answers are correct, but yes, but there are things you can. That's what the first thing you need to look at. Can I reduce my cost? Can I reduce my cost? This is why I said understanding expenses is the most important thing as an entrepreneur. This is why you need, if you have your own business, you need to read your expenses, understand them to the least detail, and think, how can you improve? We're going to divide expenses into two different categories. Expenses are the cost of producing revenues. There is something wrong with this. Anyway. So the cost of producing revenue, this is a type of expenses. What does it mean? In order to sell food, let's say, I need to buy ingredients, right? If I'm a restaurant. So if I'm selling burger, each burger, I'm selling the burger for $5, let's say, but it's costing me the ingredients, let's say, $2. Okay, that $2 is a cost of producing revenue. Now, the rent of the place, the rent I'm paying of the place, that's not cost of producing revenue. Why? Because whether I produced revenue or I did not produce revenue, I'm paying this cost. So there are two types of cost that you need to pay attention to. There is the fixed cost and there is the variable cost, okay, in expenses. And this is really very important.
Come back here a second. So the cost of the burger bun, the mustards like that, that's one expense.
That is when this is a type of expense. It's called variable expense, or you may find it in the books if you read it. Cost of goods sold, COGS.
So cost of the good that is sold, that's the burger, the bun. And then wages and rent and insurance is a different.
Exactly,
expense.
that is fixed cost. And why we want to differentiate between them?
Also, you have some fixed variable, i.e. utilities. You're gonna have utilities if you open the door,
Right.
but based on your volume of business, that could be flexing.
Okay.
For example, if you are a burger place doing 200 burgers, here's your expense for the electrics, let's say. If you do 2,000 burgers, is your electric bill gonna go up?
You think something's going to go up.
So you need this is why, and I will explain in a second why it is important to understand those ones. So your fixed expenses is your rent, the salaries that you pay, the insurance, whatever. There are like plenty of things. Now, there is a part is variable, the buns, the meat, the other ingredients. Fine. And there is something in between, like the utility. So utility, if I pay like $5,000 utility per year, 2,000 of those 5,000 are is fixed, because whether I used it or not used it, I will need the minimum. Okay, and here you can use this ratio. Now, what is better to have, more fixed or more variable expenses, cost?
You want fixed because variable is too flexible and it can really impact your bottom line.
Okay, more fixed.
But I wonder more variable, because variable is your cost of goods sold number.
Right.
Sure.
Yeah.
Yes.
And I'm not saying that I know. I
Yeah,
just-
That's
I
right.
guess it would depend on the scenario.
Well,
Because, I mean, if you have more assets than liabilities, then I would do fixed. But you're talking like, yeah, that's what I would do. So, like, for example, if you own the building and the land,
okay, regardless of whether you own the building or not, okay, you have a business,
yeah,
and you know that you have like $10,000 a month fixed cost. Okay?
Yeah.
This means whether you sold something or you did not sell anything, you have a cost of $10,000 a month.
yeah,
Right?
Right.
Let's think of it different way. Let's assume you have cost of goods sold, you generated revenue, and the revenue that you generated cost you $50,000, not 10. Well, that means I generated more, right? To pay this $50,000.
I misunderstood the scenario.
Exactly.
Right.
Exactly.
Yeah.
You took it from different perspective, like about like stability of. That's not the situation. Okay. Here now.
So we're talking about sales. Then.
Yes, it's
Okay.
cost of goods sold. It's cost of revenue. Some people call it cost of revenue. Exactly. The more variable cost, the better in this case. Okay. Why is this important to understand?
That's because we need you. That's why it's important to understand. We need someone with your.
We need.
Because it sounds like it helps you decide what your priorities ought to be for what your
That's right.
your financial.
That's
results
right.
are.
But once you understand this, you definitely avoid a trap maybe 50% or more than 50% of entrepreneurs fall into that trap and they lose everything.
And the trap is what?
What is the trap? The trap of borrowing money to set a business.
They also spend more.
If you are borrowing money to spend it on your fixed cost, you're going to hit the wall very soon. You only, in business, you only borrow money to increase your revenue. So once you set your business and you borrow money and you spend it in the variable cost, you don't go and borrow money to buy a furniture for your office or to pay salaries.
So you wouldn't call that like a loan for capital improvements to improve?
That's not capital improvement. That's
I'm saying capital improvement or anything that improves the aesthetic of your building is those are all like those fixed costs and they're not good.
Of course not. Of course, and nobody does that. No successful business does that.
So how do they pay for upgrades?
Exactly. They increase their revenue. They borrow money to take more projects. They make more profit. They fund the improvement they need in the fixed cost.
Gotcha.
No CFO for a business in the world would approve a loan to enhance the building or whatever. Well, unless you are a hotel or a restaurant and this kind of attraction, this is something different. Okay, but we're talking about regular business. You don't borrow money to spend on something that is not productive. You spend your own money on something not productive because you wanna build something. You wanna buy chairs. You wanna buy these things. This is the capital that you put, but you don't like borrow unless this is part of a project you are delivering. Like let's say in a business where you need to make some structure to generate money, you can do that after having a project.
Like an athletic center, like you have a Las Vegas, like a gym. If you own a gym, that that gym is your fixed asset is your
correct.
Your variable cost.
Yeah, correct. I said the exception here is different, and if you analyze it, you will see that's not really a fixed cost. This is a running cost because every year you need to do some kind of renovation or something like that. That's a variable cost.
Now, what about the initial loan? The initial loan to be able to buy the building and the tables
So if you are starting a business, you would find 99% of the mentors, of the consultants, they would tell you, okay, you don't really need to have a fancy office, and you don't really to have an office in an office building. You can start it in your garage. You can start it in your home. You can start in everywhere, especially today, unless you are establishing like a garage. You need a workshop or something. That's different.
So is that why restaurants fail as often as they do? Because they have to buy that fixed.
Exactly. Restaurants is a risky.
It's got to be in a nice location.
Exactly.
It's got to have all these fixed assets.
Exactly.
Exactly.
Part of the risk for restaurants, we have experts in that business here. The only
consultant in that area, you have owners who are idiots. Has nothing to do with what they borrowed. It's the fact they don't know how to run a restaurant. Here, how's that? I
I heard a more charitable explanation.
No. I think at the core of that is the idea that like people that start restaurants are typically really good with food, right? Or they like are really
correct.
Any business you start, you typically start it because you are an expert at something, right?
Correct.
For the majority of you, like it's not numbers or math, right? Unless you are me, like that's what I started a business around, right? But most people they started in this case, right? So I think the point that's being made is like they're just not educated in that space because like again like there's plenty of things that I'm not educated in that you need to run a business because I can run it from the numbers, and that's the idea of like trying to figure out how do we create that education there. One thing to your point about those fixed costs though, right? Like so for restaurants or for anyone that has a physical space, the issue you run in today is it's really expensive to buy real estate. So like unless you are very successful and retired and like well set up, you can't buy, right? Like you have to have 25% of the cost of that building, all these other things, right? But what you do have to do is wherever you go into, you have to improve that space, which is the other person's property, to make for your business to run. And that's actually called tenant improvements, right? And so the issue that a lot of restaurants run into is when you finance that, that adds extra overhead up front. Now, if you don't have enough to do it, then you have to finance, right? And so you run into that capacity. But like with restaurants, the other thing that I run into, because I have a lot of restaurants on Active Consult, just phenomenal food is not enough anymore.
No, there's phenomenal food everywhere.
Yeah, and this also, guess what? Like you're in the major leagues here, right? Like if you're in like any other city that is not a major 10 metropolitan, creating a restaurant is a lot different than here. Right? Like here, there's so many options. There's so many Michelin stars. There's so many crazy things. You have to do really well. You have to provide great value. And you've got to like provide great service, right? And I think that's what me and John were talking about earlier. Is like customer service differentiates everything, right? So I have some clients we go in and we do training, and it's just like people see and they come back for that.
Well, that's why a lot of restaurants
The
also
thing with chefs, they produce good food. They aren't always cost efficient because they haven't really dealt with the labor, the marketing, to establish the business. So they spend so much money, you just can't make the money. And chefs traditionally are notorious, very bad people managers. Because in the kitchen, they're the general, they're the captain, it's wrong.
Right.
Well, we start getting in the dining room, that attitude doesn't necessarily work real well.
Right.
That whole front of house. I don't know if any of you guys have worked in a restaurant, that front of house, back of house dynamic. So there is not a restaurant that I have ever consulted, worked in, or other that has fallen exempt from this. And I'm even talking like the best cultures. You still have this division amongst front of house, back of house, right? And so it's this really unique dynamic that happens in restaurants too. So you have to have this one mentality that's like, hey, we're go, go, go. And in the kitchen, they're like yelling at each other, kind of like pushing. And then in the front of house, it's all we smile. Like they're yelling at each other behind the partition, and then the smile comes out, right? So it's like this whole other dynamic you run into. It's more complex than a lot of
Okay, now,
sorry, go ahead.
A lot of moving parts.
yeah, thank you for this contribution. That is, those guys have lots of experience in that restaurant place. But the idea here is to understand the concept. Now, where to spend the money and where to borrow, that would require like a more complicated analysis. Like if you have a business plan that is solid business plan, and it's clear for you and everything is clear for you, and you may need to borrow to spend on the fixed, that's something else. Yeah, but in general, as a general rule, in business, don't borrow to spend on fixed income. Borrow to spend on variable fixed costs. Borrow to spend on variable costs. Just to show you an example, for like major companies that we all know about, Meta, the Facebook owners. Okay, this part on the left is their revenue. Okay, and the part on the right is their expenses. Okay, the red part here is the cost of sales. Look at Amazon. Cost of sales, which is the variable part, is almost equivalent to the fixed part, right? Between the red and the green. Look at Meta, cost of sales is so narrow, while fixed cost is huge. And why is that?
Their infrastructure?
No, Facebook, they don't sell any material. They sell services.
Yeah.
So they have to build all of these, which is fixed cost, to sell certain services. Microsoft is the same, but Microsoft, they made those computers, so they borrow something, they manufacture something, if they sell more. But Facebook, subscriptions, they have their structure, and people subscribe, so their cost is fixed. But look at Tesla here. Look how huge is the variable cost, and the fixed cost is like small. Why is that? Because they produce something. They buy lots of stuff, collect them together, assemble them together to build the cars, and they sell them. So they sell more, their expense will be variable cost will be more. Is this concept clear? So we learned so far about the balance sheet, right? And we said the balance sheet, it has a certain point of time. We learned about, and it contains like 3 elements: the assets, the liabilities, and the equities. Okay, what do we have? What do we own? And what do we owe to the market? We have the income statement. Income statement usually reflects not a certain point of time, it reflects a period. Okay, as business owners, you should always keep an eye on your income statement and study it carefully, frequently, and that period should not exceed a month. Month is too much even in nowadays, you know, and it depends also on what type of business you have. Now the government or the IRS will look at your income statement every year, right? But as a business owner, you cannot wait for a year to talking about the IRS. What do you think the tax? Is it a variable cost or is it a fixed cost?
Property tax is probably fixed, income is variable.
Yeah, property tax is a fixed cost that you have to pay it whether you made money or not, while tax is a variable cost. That means the higher the tax, the better. People don't like to pay taxes because they have a huge misconception. But I wish like my tax is like few $1 million. That means I'm making more millions, right? I wish I can reach that stage. Okay. Okay, so you understand now the variable cost and the fixed cost. Okay, and if you sell services, then your fixed cost is gonna be high and your variable cost is gonna be low. If you sell product, your variable cost is gonna be high and the fixed cost is gonna be low. If you sell a mix of both, depends on which portion is higher. I sell services. I almost don't have any fixed cost. You know why? My only cost is like my website and that's it. The material I did develop in my time. That's the only fixed cost I have, which is very, very minimal. Okay, most of my costs when I travel to deliver training or to do coaching, when I develop programs for companies, spent like that is my higher cost. Or when I hire somebody to help me. Okay, employees are fixed cost or variable cost. Employees are fixed.
Yeah.
Because if you have employees, whether you sold or you did not sell, right, you are paying the salaries. Now, you can hire a smart consultant like my colleague, and he may help you in a way to tell you hire part-time employees. Okay, when you have a project, contract the employees and bring them to the project. Don't hire full-time employees. You want to say something?
Yeah, for example, retail would be, actually, your managers would probably be fixed, but your hourly employees, you can flex them, reduce them, increase them. A restaurant on a Saturday night has a bigger payroll than probably a Monday night.
Gotcha.
Unless you're a sports bar.
Gotcha.
So that would be, salary, you're paying it whether you have 10,000 in sales or 100,000. But your hourly, you can a lot of times flex that.
Gotcha.
So I think
That's why many businesses, they now, if you look at the 60s and the 70s, they used to have armies of employees. Now they're not doing that. What they're doing, they are relying on hourly employees. They hire them like on Saturdays, on Sundays, depends on when is their like peak hour or in the afternoon, just to save, to ease their cost, you know.
So employees like at a Supercuts or a Sports Clip, that's an example of a fixed asset that can generate profit. Am I understanding that correctly?
Yeah.
Okay.
Well, now it depends on the system. We'll have to get into more details.
Gotcha.
We're talking like in general, as a general.
If they're paid hourly to do haircuts, you know, and I see your point that there are fixed costs that whether there's one customer or 100 customers, you know, they're being
Correct.
the same thing.
That's right.
But because they are the ones that are,
There is a way to, yeah, there's a way to manipulate the
Yeah,
cost. That's correct.
Gotcha.
That's a way to manipulate cost.
in that business, the hair cutter actually rents the chair.
Gotcha. Yeah, I'm trying to keep it simple. 'Cause I couldn't think of another one. You know,
Yeah.
another
Some of
example.
them do commission too.
Yeah.
Some do commissions.
How much time do we have?
I think
I probably took us over.
I think we're a little bit over time.
Okay.
You want to wrap it up with a few questions?
Anyway,
Yeah.
if you guys have any question, like I said, this presentation or this subject I have is a full day workshop, okay? But because of the time constraints, so that's why I pick the most important thing. So if you have businesses and you have accountants, ask them to differentiate and to explain to you what variable cost, and what is like fixed cost you have, and try to minimize your fixed cost if you are a small business. Anyone have any question or any comment?
It was not boring. It was awesome.
This is great.
Woo,
Thank
so
you.
much.
Thank you.
Told you bookkeeping
Thank
is
you.
sexy.
Thank you. Was it?
Bookkeeping is sexy.
Yeah.
Cost control's fun. I'm not-
You said that. I didn't believe.